happens in the market is you enter into the market without knowledge. Many of them do that. What happens? You end up in loss. But in the beginning, you make some profits. You turn these profits to losses. Some of you would have done this, right? Is that right? Agreed. Okay. Right, this is what happens when you trade with half knowledge or no knowledge. Right, even I did the same mistake. So everyone does this. Everyone does this. So with other traders, there are so many people who teach, but they don't trade. They don't trade every day like I do. I trade every day. I trade every day during weekdays. That's why I teach during weekends. So I follow some strategies. Okay, it's not rocket science, guys. It's just stock market. Okay, how many of you here are engineers? Engineers. Engineer. Okay, others. Okay, engineers. So for you guys, nothing will be a problem because you've seen max 1, M2, M3 and all this, right? In front of this stock market is nothing. Okay, we'll be learning only few simple strategies. Stick to the rules. That's all. Okay, normally with other traders, with other let's say teachers, what happens? They teach so many things. What's the result? The result would be sometimes huge profits, next day huge loss. This is not good. This is not at all good. This is not how we should trade. Okay, what we should focus on is consistent profits or small losses or break even. Break even means no profit, no loss. Small losses is fine. Sometimes it happens. Okay, because we don't rule the market. We are called retail investors. Okay, we tend to make small losses even though how strong our strategy is. Sometimes we make losses. That's not a problem because profit should be more than losses. Okay, this is my trading style. All right, this is A, this is B. Okay, how many of you tell B is better? B is better. Yeah, B is better, right? Sorry guys, I'm not well. I'll try to give my best today. B is better for everyone. Everyone agrees. Okay, that's what we are going to focus on. Okay, stock market is not gambling. This is just like any other business. Okay, for a business, what do you need? Investment. Small investment, small profits. Big investment, big profits. Simple. Okay, i'll just I'll just give you 2 minutes and open a presentation. Just write down the simple rules in your first page. Guys, everyone's able to see the screen, right? Just open it. Okay, these are the rules which you should be following strictly. Whatever happens, you will be following the rules. When you're done writing this, just unmute and let me know. I'll be here. Just take 2 minutes of your time. Just write this. I'll explain what this is later. This is something related to options trading. I'll teach this later. Just write these rules. Guys, done? Guys, written? Someone unmute and tell, guys. Done? Okay. All right. Done. Someone's not yet done, you can take a screenshot of this and write it down later. Okay. All right. What is stock market? Stock market is just a market. It's just a place where these big companies. I'll just zoom the screen a bit. Sorry. Okay, it's the place where big companies borrow money from general public and they invest it in their business. Okay, after these companies make profits using our money, that is retail investors and foreign investors. There are so many people who invest in the market. Okay, they make profits using the public's money and they distribute some of the profits to the public in many forms. I'll explain you what are the forms later. Okay, this is stock market. It's just a market where all these big companies are present. We can invest in these companies and make profits out of it. That's all. This is stock market. Okay, why can't companies take a loan instead? Big companies can go for a loan, right? Why are they not going? Is rate of interest at which the banks are offering is too high, because business loans, as you know, it's about 13 to 14 percentage. Next is banks can offer only a limited amount. A big company would be requiring like 1000 crores, 1500 crores, and all this can't be given by a bank. They can, but it's not advisable for the company, because if the new venture faces a loss, the company's other business will be at risk. A company will have so many businesses, not just one. If the company is entering into a new venture and it goes into a loss, the company's other businesses will be at risk. So they won't go for a loan. They'll enter into stock market and borrow money from public instead. Whereas after borrowing money from the public, if the company faces a loss, the loss will be evenly distributed between the shareholders, that is us. Okay, this is why companies don't take a loan, they go for borrowing from public. Okay, normally these big companies will not fail easily. Why they won't fail easily is they have a reputation to maintain. Okay, they are big companies, they have a reputation to maintain. Next is they need to borrow money from the public for their other businesses. They just don't have this business alone. They need to borrow money from the public for their other businesses. They need to sustain for a long time in the market. Like Hindustan Unilever, Reliance, all these companies, they need to sustain for a long time. So they hire the best people to look into the best booming business, that is best future business. Like what's the next future business would be like electric vehicles, AI, and all this, and they invest in those opportunities. Okay, and why they won't fail is they have to keep their brand image high. Every company has a brand image and they have to maintain it, so they won't fail easily. And shareholders, who are shareholders is when you invest in a company, you hold a percentage of stake in the company. Okay, even if you invest like 1000 rupees and hold 0.001 percentage of a company, it means you hold a stake in the company. This doesn't mean you can decide anything for the company. It just it just means that you hold a small percentage of the company when you buy the shares of a company. Okay, you don't have the deciding authority in the company till you have 51% stake in the company. We are shareholders. Next would be, guys, am I going fast or this is fine? These are just the very basic terms. It's not even necessary that you know them. These are just definitions. It will be helpful for you for your life. That's why. Next would be promoters. Am I going fast? You can text me and let me know here. Fine? Is this fine? Just the basic definitions. We don't have to concentrate in it much. Fine, right? Fine. Okay. 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 Promoters. Next topic is promoters. Promoters are the founders of a company. In news, you'll be looking at this word promoters. Like this promoter bought this. This promoter bought this many shares. This promoter pledged this many shares. All these news would be coming. I'll explain that as well. They are the founders of a company. They have total control over the assets and decision making of a company. Like managing director, they are promoters. They decide everything in the company. They have a major stake in the company and control the company. Yeah, for example, Mukesh Ambani. Prior to that, Dhirubhai Ambani was the promoter of Reliance Groups. They're promoter. Founders are also called promoters in stock market. This would be dividends. This is just when you invest your money in FD in a bank, you get a certain percentage of interest from the bank, right? Like likewise, when you invest in a company, you get a certain amount yearly from the company. This amount is called dividend. Just like interest, this is in stock market, this term is called dividend. This dividend can be variable and it's not fixed. Okay, it's fixed based upon company's performance. Dividend can it's not necessary that every company should pay dividend. When the company does well, it will pay dividend. When the company does not perform well, it will not pay dividend. This is next is tax saving and investing. The biggest advantage of investing is completely different from trading. Trading means you buy and you sell immediately or next day or something like that. Investing means you buy the shares of a company and wait for 1 year, 2 years, 10 years. This is investing. Advantage of investing is you can save tax. If you hold the shares of a company for a year, you don't have to pay any taxes in the gains which you have received. There will be no tax. This definition is called long-term capital gain. Okay, however, when the gain is more than 1 lakh, you will be paying 10% as a tax. Till 1 lakh, you don't have to pay a tax. So, as I already said, investing is different from trading. Okay, when you buy the shares of a company and leave it for a while without disturbing it, you don't sell it. Okay, this is called investing. When you buy the shares of the company and sell it immediately after the price increases within the same day or in some days, it's called trading. Traders and investors are two different sets of people. I do more of trading instead of investing. Next is platform for trading. There's a platform for trading. This is the platform for trading in India are NSE and BSE. NSE is National Stock Exchange. BSE is Bombay Stock Exchange. We won't be using this. We won't be using BSE. We'll be using only NSE. The main reason is in BSE, in Bombay Stock Exchange, there are so many bad companies without any background check. These companies have been listed in BSE. So we won't be using it. We'll be using only NSE. NSE is the most widely used platform. All the Indian companies which want to borrow money, okay, from the public, they'll apply to SEBI, SCBI. It's a regulatory body, and they will get listed in NSE and BSE. There are 5,000 companies in the platform. This is your NSE website. NSE 1. Something's wrong. Yeah, 1 second, guys. Okay, this is the website. If you want to search for any company, you can search it here, like HDFC Bank. We're doing screen recording, so this is a bit slow. Okay, one share of HDFC Bank, the price of one share is 1500. Okay, now you can see all the other details here. I'll teach you how to see all that and what's necessary, what's not, and everything. This is just the NSE website. Whatever companies, these 5000 companies, you can search for it here. Next is market timings. The market opens at 9 a.m. and closes at 4 p.m. but we can't trade from 9 a.m. to 9:15 a.m. and after 3:30 to 4 p.m. That timing is just for brokers. Okay, and why we can't trade is the price fluctuation will be too much from 9 a.m. to 9:15 a.m. and 3:30 p.m. to 4 p.m. the price fluctuation will be too much, profits will be too high and losses will also be too high. Since we are retail traders, we can't handle it. That's why we are not allowed to trade from 9 to 9:15 and after 3:30 to 4 we are not allowed. We can trade only from 9:15 a.m. to 3:30 p.m. However, this is not an MIS. You can place an order at 9:08. Okay, you can place an order at 9:08 and if the price matches the demand, it will get executed or it will get rejected. But don't do this. This is risky. Never do this. Wait for the market to open. Wait for all our conditions to satisfy and then execute a trade. Never do panic trading. Just trade in a relaxed way. So ignore this. Ignore this. We'll be trading from 9:15 a.m. to 3:30 p.m. That's all. The one thing which I follow in stock market is big players. They control the market. What they do is the real market scenario. What happens is 92 percentage of people lose money in the market. Why? Because big players trap them and take their money in some way. Okay, whatever techniques they follow, they'll be trapped. So what I do is I just follow the big players and what they do. I do what they do. Okay, I do what they do. I'll be teaching the same. You can also do the same. Big players are mostly FII and DII. FIIs are foreign institutional investors like Morgan Stanley Pension Fund of Canada. There are more. There's Bank of Singapore. There's Hong Kong Bank. So many people invest in Indian stock market because Indian stock market is developing, not like US stock market which is already developed. Alright, next would be DIIs. DIIs are domestic players, domestic institutional investors. For example, LIC, HDFC mutual funds. These are domestic investors. Alright, they invest in stock market and make profits. Their main aim is for retail investors to lose their money. That's all. That's their main aim. Money is just transferred from impatient people to patient people in the market. That's how money is transferred in this market. Next would be LTP. LTP is last traded price. It's the price at which the share was sold last. It varies every minute due to fluctuations in the price. Like I showed here, HDFC Bank. This is the LTP of HDFC Bank. LTP is last traded price. This last price was 1507 on Friday when the market closed, Saturday and Sunday market would be closed. Friday evening at 3:30 when the market closed, the price would have been this 1507. So this is the LTP. So when Monday market opens, the price will vary, and again LTP would vary every minute. It will be fluctuating. It's the price at which the share was sold last. Whenever you want to buy or sell a share, you should be looking at LTP and decide whether to buy or sell or hold, because you'll be looking only at the price, right? That's why this will be useful. LTP. Next is types of trades. One is intraday trade, that is square off means closing the trade on the same day. Intraday trade. Okay, I'm more of an intraday trader. I'll buy today, sell today. Okay, I'm not a buyer. I'll just teach you what I am later. I'm an options writer. I'll teach you about it. Okay, when you buy something and sell on the same day, it's called intraday trade. When you buy something and hold it for some time, like 2 days, 3 days, or 1 month, it's called swing trading or positional trading. Swing or positional. Next would be long term. Long term, it's like an investment. Like you buy gold and forget, it's like an investment. Like you buy it and you hold it for 10 years, 15 years, or 5 years, or whatever. These are the types of trades in the market. This is buying and selling. Okay, if there is more demand for a share or company, the buyers are high for that particular share. So what happens is the price moves up due to continuous high bidding. Bidding means one person would be asking it for, if one person is ask 1 second, if one person is asking it for 100, like auction, another person would be asking it for 101, another person would be asking it for 102. This is how a stock's price rises. Okay, if there is less demand for a share, what happens is they'll be selling same thing from 100, 99 they'll sell, 98 they'll sell, because buyers should be asking it for a lower price since there is less demand for the share. What can be done in stock market is you can either buy a share first and sell it, or you can sell first and then buy it and make profits. Buying first and selling it is, if you're buying 10 shares of, let's take Ashok Leyland. Ashok Leyland's price must be somewhere about 100. 10 shares of Ashok Leyland. Okay, you're buying. So price rises, price becomes 103. Okay, price becomes 103. Profit you made is rupees 30. Just an example, rupees 30. You can also sell a share first and make a profit. This means you are expecting the stock price will go down. So you're just clicking on sell. It means here what you did is you did plus 10 shares, okay, and then you sold. Hold on a second. and you sold means plus 10 and minus 10. I'll just write it down like this, plus 10 and then minus 10. Now you don't have anything, it means you don't have anything, right? Plus 10 and minus 10 is equal to 0. Here what you do is, first it would be minus 10 and then plus 10. If you sell and buy, now what's the result? Same 0, you don't hold anything. But if the stock price goes down, you would have made a profit. This 30 would be the profit, like from 100 it goes to 97, you would have made 30 rupees for 10 stocks. Sell and buy and sell, simple. Guys, got this right? Simple concept. Just text, guys, just text and let me know here. Yes, okay. All right, done. Okay. Okay, this thing is, this is Nifty 50 and Bank Nifty. What this means is, Nifty 50 is the measure and combination of top 50 Indian companies. Okay, top 50 Indian companies. I'll just show you here. Okay, these are the top 50 Indian companies. If all these companies do well, that is, all these stock prices are rising on a day, this Nifty 50 will also rise. Okay, this has a price, Nifty 50 has a price, that is 15,000 something now, 15,300 I guess. This will also rise, since it's just a measure of these Indian companies. It's just a combination or measure of all these companies put together. If these companies perform well, Nifty 50 will perform well. If these companies, all these companies are in red, like they're not performing well, the stock price is going down, this Nifty 50 will also be in red, or this price will be affected, will be going down. Next would be Bank Nifty. Okay, I'll just explain this as well. This Nifty 50, Bank Nifty, along with Sensex, is called the market. Okay, when the companies perform well, when the stock price of companies rise up, Nifty 50, Bank Nifty and Sensex will rise up. If these companies stock prices go down, all these will go down. This is just a measure. Okay, right now Nifty 50, okay, this is not at 13,600, it's now at 15,350 something. This is just the price of Nifty 50 now. Bank Nifty means, Bank Nifty is the measure of top banks in India. The level or price of Bank Nifty right now is set. This reached 35,000 now. This came to 35,000 now. These are known as derivatives, and trading is allowed in it. We can trade in Nifty 50 and Bank Nifty. That's mostly what I do. Trading is allowed in it. Okay, well, now I'll just tell what constitutes Bank Nifty. Bank Nifty, HDFC Bank has 20% of weightage, 20 to 22, just write it as 20% of weightage in Bank Nifty. If HDFC Bank is down, Bank Nifty will be down. ICICI Bank has like 15% weightage. Next would be Kotak, SBI, Axis, IndusInd. These are the main banks which you'll be looking at. They constitute Nifty, Bank Nifty. Bank Nifty or Nifty Bank, whatever. If HDFC Bank goes down, Bank Nifty will go down. Next is gap up and gap down. When the market or anything, I'll just show an example. Guys, this is TradingView. This is a website which we'll be using to analyze and look at the charts and price of the stocks. Okay, TradingView, trading VIEW. You'll just have to create a free account in this. I'll just open it here in a new page. This would be your home page of TradingView. Okay, if you want to look at stock price, okay, you'll be let's take Reliance. You want to buy shares of Reliance, so you're looking at Reliance. Clicked on Reliance, NSE, always NSE. This is the price, this is the stock price, this is time. Okay, this is time, this is the graph. You can select either this lines or candles. Candles would be the perfect thing to analyze this. I'll be teaching what is candles later. You can select candles and time frame can be selected. Like if you select 15 minutes, data will be updated for every 15 minutes. 12:30, 12:45, 1 p.m. like this. If you select 5 minutes, data will be updated every 5 minutes. It's always better to use higher time frames to get better data and better results. Okay, what was I about to explain? Gap up, gap down. Okay, this is 28 May, that is day before yesterday. Friday's data. This is Thursday stock price of Reliance ended at 1966 at 3:30 p.m. at 3:30 this is the price. At 3:30 what happened is at 1980 89 or something it ended. The stock price ended at this price. The next day the stock price, that is at 9:15 a.m. next day, it's opening at a higher price, that is 1997. So this is called a gap up opening. If it opens at a higher price than previous day, it is gap up opening. If the stock price opens at a lower level than previous day, it's called gap down opening. If the stock price opens at the same level, same price, it's called flat opening. Simple. Got this right? Guys, any doubts you can text me here. Easy, right?